Coming up on Market to Market. Two trade deals take one step closer to the goal line. The debate over protein levels in livestock feed.
Over the short term.
And commodity market analysis with Dan Huber next.
So we need market intuitive leverage.
Pioneer Hybrid International is a proud sponsor of Market to Market.
Sukkot Manufacturing Company, providing equipment and buildings to store and condition grain to help farmers adjust to market swings. We build drying, moving, and storage equipment designed to preserve the quality of their crops. Sukkot Manufacturing, store now, profit later.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. This is the Friday, January 10 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Delaney Howell. The on-again, off-again negotiations with China appear to be on again. The rumors and news in advance of the most recent announcement colored some of the economic numbers. The unemployment rate held steady at 3.5% as the boost from striking GM workers returning to the line begins to fade. Only 145,000 jobs were created last month, well below the 200,000 the Fed believes is good for the U.S. economy. The trade gap narrowed to $43.1 billion in November as the trade war with China continues to cut into imports and exports. After several false starts, Vice Premier Liu He is expected to arrive in Washington, D.C. next week to continue high-level negotiations in the U.S.-China trade war. As plans are being made for Liu's arrival, the USMCA started moving through the Senate. Paul Yeager has the story.
Reasons why I think that way. USMCA will bring much needed certainty and real benefits to America's farmers, workers, and businesses.
The Senate Finance Committee started the new year considering the United States-Canada-Mexico agreement. The measure passed the House in December. Senator Charles Grassley says American farmers are getting more reliable market access, which includes provisions aimed at wheat and dairy access to Canada. The agreement could create new jobs and raise wages, particularly in manufacturing. Part of the criticism of the 1990s-era North American Free Trade Agreement was the lack of provisions for the digital economy. The internet has changed commerce around the globe since then, but little language existed to regulate the trade between countries in the $1.3 trillion e-commerce economy. According to Grassley, enforcement flaws were addressed in the bill.
The bill before us today has something in it for everyone, and it's not often that we can say that about an implementing bill.
A long list of supporting organizations of the measure were entered into the record, but this is one of many trade actions in motion for the administration. With USMCA at the 5-yard line, business leaders are hoping the trade agreement will make it into the end zone soon.
Businesses of all sizes and shapes don't like uncertainty, and not having trade deals or having trade deals in flux or in motion doesn't help as businesses are trying to plan for their future and trying to figure out how they're going to invest their capital into 2020. So the sooner we can get these trade deals agreed to and negotiated and signed, the better it will be for Iowa's economy.
For Market to Market, I'm Paul Yeager.
The Chinese New Year will be celebrated on January 25th. In 2019, pork prices in China nearly doubled as supplies dwindled due to African swine fever and high tariffs on U.S. imports. In September of last year, import tariffs were lowered in an attempt to alleviate some of the pressure. As Chinese producers continue rebuilding their herds, they will be looking to source their feed based on price and protein content. Colleen Bradford-Krantz took a closer look at how U.S. soybeans measure up in our cover story.
For decades, the soybean meal used in livestock feed was evaluated by the percentage of protein it contained. The higher their protein, the more the soy meal was valued as a way to grow healthy, strong livestock. So when studies pinpointed a slight but notable decline in U.S. soybean protein levels, 0.8% over 30 years to 34.3%, some livestock nutrition experts and plant breeders became concerned.
Well, the decline we see in protein concentration in soybeans and in soybean meal is a pretty big deal because it reduces the value. And you have to remember, pigs and poultry, they consume more than 75% of all the soybean meal that is produced in the world.
Jeff Thompson, a research lead for North American soybeans at Corteva Agrisciences in Johnston, Iowa, points out that as yields have increased, the amount of protein produced per acre has actually grown. But he understands how the dip in the percentage in each bushel is problematic for livestock producers.
So as protein concentrations go down, more soybeans need to be crushed, and that alters the feed rations for poultry and swine in particular. That rate of decline has been slightly greater than the rate of decline, say, in Brazil. And the reason for that is temperature is also a component. So when temperatures are decreased, especially during seed development and maturity, protein levels tend to go down.
While most of the expansion of soybean planting in recent decades has been to cooler climates of the northern U.S., the bulk of expansion in South America has been to warmer regions. U.S. industry leaders acknowledge the lower protein levels could mean the loss of market share. For row crop farmers, there is no direct financial incentive to focus on the amount of protein. When taking their soybeans to the grain elevator, farmers are generally paid solely on the number of bushels they bring in.
You got to look at what is going to return for what I'm paying for the seed, what I think will be the best for my ground and for my acres. That's our bottom line, to see if we're going to, be above or below the profit line.
The two traits tend to have an inverse relationship. As yield increases, protein tends to decline. A soybean checkoff funded study suggests farmers could earn an additional $7.70 to $12.96 per acre if they increased protein levels by 1%.
In the 21st century, as we've gotten so good at our technology and what our expertise that we can do, that we should be looking a little bit deeper as to actually what the meal needs to do for whatever we're feeding it to.
Researchers and animal nutritionists are taking a deep dive inside the soybean and examining essential amino acids, which generally increase as protein percentages move higher. Animals are unable to make these amino acids on their own and must consume them to grow. A debate has arisen over whether the increase in the essential amino acids, lysine and methionine among them, slow a bit once a protein moves beyond a certain percentage.
This is a hotly contested subject, this whole thing about, are U.S. soybeans high enough in protein? Can we compete with South American soybeans? Are northern United States soybeans high enough in protein to compete with southern United States protein? But again, these new studies and these studies that are going to continue to really look at, is it all about total protein, crude protein levels, or is it about analyzing and determining the right amino acid balance?
Some are already advocating that soybeans should be marketed by amino acid levels rather than overall protein.
My bias, based on the data I've seen and based on my understanding of the biochemistry, I think we're going to migrate rather quickly towards analyzing soybeans and the meal from soybeans at the amino acid level rather than the total crude protein level.
Internationally, I've been on some trade mission, educational missions, and that's the first thing that's always thrown up to U.S. producers is that our soy, our protein, is just a little bit less than that might be from South America or from other sources. And so it's a hurdle to get over to having to talk about something besides protein as far as the value of what they're buying.
Stein says this may change. Synthetic amino acids are becoming more commonly used in both Asia and the U.S., threatening soybean meal's position in feeding livestock.
Feed companies and the integrators, they can purchase individual amino acids and more of them, which means that they need less and less soybean meal. And so I think that's the biggest competitor. It would take the entire industry, but the crushers more than anyone else, to change how they pay the producers for their soybeans. So if a producer is rewarded for delivering high amino acid beans, then the producers would start changing and start selecting those high amino acid beans from the breeders.
At Corteva, where it takes 7 years to develop and release a new soybean variety, researchers are focused on yield first and disease and pest resistance second. However, they are not discounting the need to watch protein percentages.
We in the research community really need to strike a balance between protein concentrations and yield. And what our goal could be would be to stabilize the decline in protein concentrations while continuing to improve yields. That would be a way that we could benefit both the animal agriculture industry and our farmer customers.
For Market to Market, I'm Colleen Bradford Krantz.
Next, the Market to Market report.
The potential for conflict with Iran and commodity traders positioning themselves for Friday's WASDE dominated the markets for most of the week. The report overpowered those factors in the final hours of the last session. For the week, March wheat gained a dime. The nearby corn contract had been trending lower but ended flat in the wake of the report. The March soybean contract whipsawed its way through the week. A 13% decline in year-over-year soybean stocks helped add a nickel. March meal gained $2.30 per ton. Cotton continued a 7-week rally as the March contract gained $2.11 per hundredweight. Over in the dairy parlor, February Class 3 milk futures fell 6 cents. The livestock sector was mixed as the February cattle contract gained $2.70, March feeders put on $4.77, and the February lean hog contract shed $1.30. In the currency markets, the U.S. dollar index was up 51 ticks. February crude oil dropped $3.97 per barrel. COMEX gold added $10.10 per ounce. And the Goldman Sachs commodity index plummeted more than 15 points to finish at 429.15. Joining us now to offer insight on these and other trends is one of our regular analysts, Dan Huber. Dan, welcome back.
Thanks very much. Great to be here.
Dan, we had a couple of reports really that happened this week, kind of non-event maybe, and I want to get to that here, starting off with what happened in the winter wheat seedings this week. It seemed like that was a friendly sign for the markets, but we didn't really see a lot of movement on Friday.
No. And again, I don't think it was a major shocker by any stretch of the imagination. We were already looking at 100-year lows as far as acreage is concerned. So it, I think that just really kind of reconfirmed what was out there. And you had a little mixed news from other parts of the world. I mean, we certainly know that there's major issues in Australia, but I mean, I think that's been kind of digested into the market. Then you turned around and Argentina actually boosted, or I should say the Buenos Aires Grain Exchange boosted acreage there just a touch. So, all the two just seemed to conflict with each other a little bit and kind of left us a little flat-footed, although the wheat market certainly has done well over the last month and a half. So it, I think it's finally starting to show life and recognizing that, yes, there's not perfection around the world by any stretch of the imagination.
It certainly has seen a lot of strength lately, Dan, and I think that cues us up nicely here from our question from Darren on Twitter. Funds appear to be heavily short in spring wheat. Will this market blow up at some point?
Well, and of course, that's probably going to be more of an impact in the spreads. Yes, they've been short in the spring and a little long in or at least reducing shorts in Chicago. So I think ultimately, yes, they're going to have to come back out of those spreads. Maybe we'll start finally to bring the relationship between Chicago and Kansas City back into something a little more reasonable. But here again, too, the whole delivery process on the wheat has become a little bit skewed over the years. So it's, are those spreads more of a function, or are the relationships more of a function of just the way the spec wants to trade the spreads? It's a $1 million question that I guess the market's going to tell us here soon.
And Dan, I think final question has got to be, where are we going to head from here? Are we going to break through that next resistance level and head higher?
You know, in longer term, I like what I've seen in the wheat recently. I think we've got some higher ground to come. That said, you know, we're pushing back up against summer, spring highs. I think it's probably going to be challenging right at this point in time without something very positive today in this report. It's probably going to be tough to push it through at this point in time. But I think as we move out more into the spring, certainly I think this wheat market is going to, and traditionally wheat should be the one that kind of leads the way out when it comes to the grains. And I think it's finally starting to show those colors right now.
I think producers at home are probably hoping that it pulls the corn markets higher, but corn did not have any sort of an event going on in this week's report, it seemed. Why did we see so much sentiment placed or importance placed on this week's report to have it be kind of a non-event?
Well, you know, the report itself, of course, is kind of the final word for this last production year, although then, you know, immediately after the report was released, the government said, well, it's not really the final word because we're going to resurvey the northern plains.
What do you make of that?
You know, there's probably some minor adjustments later, but I really think even down the road, I mean, we probably, I mean, granted, we keep saying this is going to be the harvest, it's going to be down, you know, this push it down the road further. It's probably going to be the September grain stocks before we have a great handle on last year's crop, because I don't think we've adequately reflected some of the quality issues that are out there. And you'll probably start seeing that in basis levels on certain parts of the country, because in the upper Midwest, the northern plains, we've probably got a lot of grain that will not make export grade. So there's going to be a lot of interesting moves along there. But, you know, actual crop size, yes, I think we're probably going to be well out almost to new crop before we finally get a great handle on what happened this last year. You know, yes, the USDA finally adjusted the harvested acreage down a little bit more, maybe not adequate enough. It was a little bit surprising to see him boost yield on corn a bushel. But that said, when you look at the world stocks were all reduced on ending stocks. You know, we're going to be under 2 billion. Psychologically, that's a good number for the U.S. So, you know, now we'll start to reshift focus into what kind of acreage can we look at for 2020. So
it's crazy that we're in 2020, but it's crazy that we're talking about acreage for 2020.
Certainly.
Dan, what about when you look at the March and also the December contract there? We've got 385 in the March and a little over 402 in the Dees.
You know, and of course, when you look at that 385, I think that is kind of the base. You know, even over the last 2 or 3 weeks here, we've gotten down to this 285 level, or 385 level, I'm sorry. And it looks like a point of value. The market tries to push below there, and we snap right back up to that level. And even today, you know, that's where we kind of came back for the close. So I think that's a foundational level, let's just say. We're going to need something to stimulate us to carry us up and away from there. But I think when you look at that $4 December corn, I think we're trying to keep enough incentive there that we don't start losing acreage as we come into the spring. So, you know, is there a lot of upside potential from $4? You know, probably nothing. You know, a 5% rally is probably going to be a great gift here at this point in time. But, you know, until we get a better handle on the planted numbers come in late February, of course, from the USDA, and then ultimately the prospective plantings at the end of March, you know, we're probably going to keep in this $4 plus range for December corn.
Dan, looking at the soybeans, they also had an increase in yield. It was just a half a bushel per acre.
Sure.
But again, I think that poses the question, why did the USDA change it, you know, in a way that producers weren't expecting?
Well, you know, and of course, realistically, this report is partially surveys from producers. Part of it is surveys from grain elevators and what they came across scales. So, you know, I guess I'm not going to, you know, pick too much on how they came up with the number. I'm sure some of it's also statistical analysis. You know, it's history technically now. It was not enough of a shift on any of those numbers to really upset the market. You know, and of course with the soybean market, we can immediately now go back to start talking about China. You know, so it's we haven't talked about China for 3-4 days now. We need to talk about China again. So
I'm sure we certainly will in Market Plus, but I've got to ask, is it Chinese driven or something else that's continued to spur the cotton markets higher?
You know, you know, good question. I mean, certainly, I think optimism, and there could be some more business coming into China there. You know, also, it could be just a situation we, for so long, were under such pressure. You know, never really seemed to adequately reflect, you know, what was happening in production. And yes, I think it's certainly a combination of both. Weight a little bit heavier towards the Chinese, the potential Chinese situation. But boy, I mean, there's a market that's certainly one of the commodities that seems to be leading us out of the doldrums here. So
absolutely, and it's going to be interesting too, Dan. Do you see any cotton pulling acres from corn, soybeans, or wheat?
Well, yeah, it would be easy to think we could pull it away from soybeans if we do not find something, very substantial on when we ultimately find out what this phase one deal is going to entail. But certainly in the South, I mean, granted, cotton is a very expensive crop to plant, but here again too, it's if it can rotate some bean acreage away, that would make economic sense at this point. So,
Dan, the cattle complex had quite the week, especially in the feeder cattle complex, adding 477. Sure. What was going on this week?
Well, here again too, I think it's a situation where the grains are dead. It looks like we're going to have if we're going to find usage for grains, it's going to be walking it to market through the livestock sector. Demand stays pretty solid. We're not seeing the slaughter numbers. I guess my caution there is that I think packers are continuing to lose margin. And I don't think we're too far off the point where they're going to start cutting back in hours, trimming, whatever they can do to start pushing those margins back in, get the weights a little bit heavier. So it's, for right now, I guess if you can put animals in and hedge them off and you make money, you go ahead and continue to do it. And I think that here has certainly helped that feeder market out.
And live cattle, they've been trading in a range here. They did add some this week, but do you see them breaking out one side or the other?
I think it's going to be difficult, unless we see one of the caveats there, if we see the dollar turn lower, sharply lower, I think you could really start to stimulate some exports. The dollar is teetering on the edge. I mean, I think we probably have seen a high, but we just haven't been able to completely push it over the edge just yet. But, when you look at the cattle market for the last month now, we've reached up to these highs. We've not been able to back away from them. But on the same token, we can't seem to stretch any further. And I think you've got a lot of price competition with poultry and pork bulls. So it's going to be pretty difficult to see the cattle move higher without seeing the other meats, come up and, be a little less competitive, I guess.
I've got to say my follow-up question to that then, Dan, is how long can we stay sustained at these higher levels?
Here again, I guess it's been almost a little bit counter-seasonal the way we have stuck in here. So, I'm surprised we stayed here as long as we have. Let's put it that way. But if it was in my risk out there in the feedlot, I think I would be risking that we're not going to stay here very much longer and go ahead and get things hedged up.
Okay. So. And Dan, we've got to talk about the lean hog markets. We're still seeing a big gap between the cash and the futures. Are we going to see cash catch up with the February contract in particular?
Well, not that we won't catch up some, but I mean, you have the proverbial problem in the livestock market that so many hogs are under contract. The packer doesn't really have to get out there and get very aggressive with them. They're pretty comfortable knowing that we've got, when you look at the hog and pig report, how many heavyweight hogs are out there right now. So I think we're going to look at historically wide basis levels just as an ongoing problem here at this point in time.
And not even only the cash is so much cheaper or so much at a discount compared to the futures, but the spread between February and the deferred is also very...
Well, a little bit wide, but that is probably not as unusual as what we're dealing with in the cash market. But certainly when you look out in those summer months, we're up towards what have been the high side of the market for the last several years. So now granted, maybe we'll finally see something come to fruition here on more pork going out of the country. I mean, and it has. We've seen a nice pickup on particularly the exports to China. I think last week, or China now has displaced Japan as our number 2 customer. Mexico still stands there as number 1. But here again, without seeing some kind of a further problems elsewhere, and granted, there was stories this morning that Germany's a little bit concerned because there was, I think 18 miles from the border, there was a case
African
of
swine fever, right?
Showed up in Poland. So it's those type of things can certainly disrupt the logistics of the livestock market. But we almost, with 3% more hogs again this year, we're almost going to need to see something like that to really think prices can get much better than they stand today.
Dan, I want to end our discussion. Last week on the show, we were sitting in a position where we thought, we don't know what's going to happen between the U.S. and Iran. Is this going to be some sort of black swan event for the market? As it sits today, I know things can change, but
certainly.
are we factored out of any more risk-off things in the market?
I think the risk off is probably taking care of itself at this point in time. Now, granted, yes, something could turn for the worse there. We don't know what's going to happen with this Downing of an airline, although Canada's one seems to be more impacted than we are on that one. But that said, yes, it is certainly a volatile situation. The tone seems to be that neither country really wants to escalate it further than it has. They've each kind of made their points, and granted. On one side of the coin, of course, you did accelerate crude oil for a while, which has turned down since. You certainly accelerated gold to the upside, which has really lifted up that commodity indexes over the last several weeks. And here again, rising tide lifts all boats. So, maybe it's not bad for all commodities.
Dan Huber, thank you so much.
Certainly, my pleasure.
That wraps up the broadcast portion of Market to Market, but we will keep this conversation going on Market Plus, where we'll answer more of your questions. You can find it on our website at markettomarket.org. I'm Delaney Howell, and thanks for watching.
Market to Market is a production of Iowa PBS, which is solely responsible for its content. Pioneer Hybrid International is a proud sponsor of Market to Market.
Sukkot Manufacturing Company, providing equipment and buildings to store and condition grain to help farmers adjust to market swings. We build drying, moving, and storage equipment designed to preserve the quality of their crops. Sukkot Manufacturing, store now, profit later.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.